Welcome to this FinTalk series episode. Today, we're going to talk about something that might sound a little intimidating at first, equity investments. But stick with me because we're going to break it all down. By the end of this, you'll see it's really about owning a piece of the pie and why that's so important for your financial future.
So let me ask you a question. You work hard for your money, right? But is your money working just as hard for you? If it's just sitting in a bank account, it's not really doing much. In fact, with inflation, it's actually losing a bit of its power every single day. We're about to dive into one of the best ways to get your money off the sidelines and into the game.
All right, so let's start with the absolute foundation. What in the world is equity? At its heart, it's actually pretty simple. An equity investment just means buying shares in a company. And when you buy shares, you literally own a tiny piece of that business. Think about a company you really believe in. When you buy their stock, you're not just a customer anymore. You're an owner. Their wins become your wins. It's a total game changer. And you've got a few ways to do this. You can buy individual stocks. That's where you're picking specific companies you think are going to do well. Or you could go with a mutual fund or an ETF. Now, you can think of these like a pre-packaged bundle of lots of different stocks. It's a great way for beginners to get started because you're instantly diversified without having to be an expert stock picker. So why even bother with all this? What's the big payoff? Well, this is where it gets really interesting because the potential reward is huge. The biggest draw, for sure, is the potential for high returns over the long run. Plus, as an owner, you might get paid dividends. That's your cut of the company's profits. But maybe the most important benefit is this: beating inflation. This means your money isn't just keeping up, it's actually growing its real-world's buying power over time. And you can get started with just a small amount. And hey, don't just take my word for it. Look at this chart. Historically, the returns from equities have just blown safer options like bonds or fixed deposits out of the water. That gap you see, compounded over many years, that is what can build some serious wealth. But we've got to be real here. High potential returns always come with risk. A smart investor knows both sides of the story. So let's talk about the challenges. Yeah, the stock market can be a roller coaster. Prices go up and down, sometimes wildly on a daily basis. There are absolutely no guarantees here. You could lose money. And honestly, for a lot of people, the hardest part is just the emotional stress of watching your account balance bounce around. That can be tough. Okay, so you know the what, the why, and the risks. How do you actually take that first step? Let's make it super clear and simple. It's probably easier than you think. Here's your game plan. First, know why you're investing. Is it for retirement, a house? Knowing your goal is key. Then you'll need what's called a demat account. It's just a digital wallet for your shares. After that, it's research time. And remember, you don't need a fortune to start. Begin with an amount you're comfortable with. And please remember the golden rule: diversify. Don't put all your eggs in one basket. Getting started is one thing, but being successful over the long haul, that's about developing the right habits and the right mindset. This is a marathon, not a sprint. Successful investors tend to have a few things in common. They think long-term. Many use a cool strategy called dollar cost averaging. That's just investing a set amount of money regularly, say every month. It helps smooth out the bumps. But you know what the real secret is? They master their own emotions. So let's talk about the biggest mistakes people make. Number 1, jumping on a hot tip from a friend or something you saw online without doing any real research. That's not investing, my friends. That's just gambling. Mistake number 2 is just as bad: not diversifying. Going all in on one single company is a massive, massive risk. If that company has a bad run, your entire investment is in trouble. You have to spread the risk around. And the third one, maybe the most common of all, is panic selling. The market will go down. It's not an if, it's a when. Your gut will scream, sell, but selling when things are down is how you lock in your losses for good. The smart move is to stay calm and stay the course. And that kind of brings us full circle. Yes, investing in equities has risks. Of course it does. But when you think about inflation eating away at your savings year after year, maybe the biggest risk of all is doing nothing. So now that you've got the lay of the land, the good, the bad, and the ugly, the real question is, are you ready to start your own journey and put your money to work? Thank you for listening to this FinTalk episode.